Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's get in Thomas Pugh, who's commodities economist at Capital Economics, and he joins us on a phone line. Thomas, hi, good to have you. How have you been reading the commodity markets, really? There's so much happening in the global markets in sense of currency, geopolitics. The whole import tariff is how we started this week with, especially for the crude oil prices, where we are up nearly 7% for the week. Where do you see the prices head on from here?
Yeah, so the latest surge in oil prices certainly has been driven almost entirely by geopolitical concerns. Escalating tensions in Syria between the US, Iran and Russia make it more likely that the US will reimpose sanctions on Iran in May when that next comes up for review. The US sanctions on Russia, which were announced on Friday, so they don't curtail Russian oil exports directly, but they certainly add to tensions there. Throw into the mix the alleged chemical weapons attack over the weekend, and that heightens the chance that the US will either impose further sanctions on Iran and Russia, or there may even be some sort of military conflict which has the chance to escalate. And then just yesterday we saw there was another missile attack from Yemen over Riyadh, where those missiles got intercepted. The Yemeni Houthis have really started to target Saudi Aramco's infrastructure in the region. Earlier this month there was an attack on an oil tanker in the Straits of Hormuz. If any of those are successful, then that could have a serious impact on supply.
Thomas, what is your sense on where are we headed from here on? Because when you look at the demand situation, that seems good. Longer term supply, the markets do believe that the conventional supplies would continue the decline there, or control there could support prices. So when you look at the US shale output on one side, and when you look at the geopolitical tensions on the other, and then of course on what OPEC is trying to do with supplies, where do you see and how do you see the crude oil prices reacting?
So, given that the latest ramp up in prices is more or less purely based on risk premium and geopolitical tensions, and given that investors, the investor positioning, investors' net long positions are close to record highs. If there is a sign that these tensions are coming off, we could see prices fall back quite sharply. On the fundamentals side, we still think that the market is likely to be oversupplied in the second half of next year, and the prices where they are kind of Brent above 72, WTI at 67, is only going to encourage more US supply to come back onto the market, which just exacerbates that oversupply that we're going to see in the second half of the year. So we really think that prices are going to fall back by the end of the year, and the risk is that we get a very sharp fall in prices if these geopolitical tensions ease and investor positioning starts to come off.
So what you're saying is that we are not perhaps going to hold around these levels, and what kind of a range would you see for the rest of this year now?
I think certainly between 70 and 60, like we've had already, and then the second half of the year, I think we'd be moving into a range closer to 60, 65. Assuming that these geopolitical tensions ease and there aren't any actual physical attacks on oil infrastructure, or a serious conflict in the Middle East between any of the parties there, that would change things. But for now, prices lower by the end of the year.
Sure. Thomas, before we let you go, a quick word on the metals as a sector as well, where there has been a very sharp decline today. The seasonal demand pickup has been slow, and zinc clearly seems to be the most impacted.
Well, we've certainly seen aluminium up a huge amount, given the US sanctions. But this may well be more of a temporary boost to prices over the next 6 months. It's not clear that the sanctions will result in Russian output actually falling that much, especially if it can get around them by selling to Asian countries who perhaps would not be so concerned by the US regulations.